Alright, the stream is gonna start in a couple of minutes. Hold on one sec. Alright, um, I'm going to wait just a couple of minutes. Alright, I think that fixed it. Sorry about that. Gonna wait a couple of minutes, and hopefully in the next 1 to 2 minutes we'll get this started. So, if you have any questions, you can type them in the chat right now. And I mean, yeah, we'll just wait for a couple of people to roll in, and then we'll get started pretty shortly. So all right. I think we can start. Give it like 30 more seconds for maybe a couple of people to roll in. So if you didn't already know, today I'm going to be doing a live stream about some common myths about money, how they affect our lives, what they are, right? I'll explain them, how they work, and hopefully everyone can learn something from this. Even if you know a lot, you might learn something new today, and even if you learn like a small thing, that's still important to me. So hopefully we can do that, and it'll be a lot of fun. Yeah. I think we can start now. So all right. These are some common myths about money disproved. Uh, you don't really see a lot of people talking about this, so that's kind of why I covered this. Maybe you'll learn something new, maybe you won't, but at least it might be a little bit of fun. So, yeah. First, about me. Who am I? My name is Nirvan. I am almost 14 years old, turning 14 in 2 days. I'm in the 8th grade. Some of my hobbies include reading. I love to read, whether it's fiction, nonfiction, about money. I like reading a lot. I like playing video games when I have the time. They're pretty fun. I enjoy it. I play lacrosse. I've been playing that for 2 years now. Started in 7th grade, so I still practice. Like I play. It's season. It's the season started, so that's fun too. And of course, finance and things related to money. So why do I care about this? So I'm gonna give you a little story, like a minute long. I don't want to bore you with all the details, but I remember back in COVID, I had gotten this book, and I'll show it maybe towards the end of the stream. Um, that I started reading, and it was about money, the history of it, how it works. Right, that's the title of the book, How Money Works, and it really fascinated me. I was interested in things like the stock market then, but I never really did anything with it. I never really cared too much about it. After watching that, reading that book though, I really started learning about how money works, started to kind of enjoy learning about the different things, how markets work, right? Supply and demand, a lot of stuff, right? But it was all really fun, and I enjoyed it quite a bit. So the all right, so did I not transition? I'm sorry about that. Okay. All right, now we're transitioned. Sorry. Um so right now I am I want to share more about finance to others, right? People who might be a little bit interested, people who might not be interested, right? But finance is something that I think affects everyone, and the more people that are educated about it, the better it'll be for everyone, right? Because if you're not knowledgeable about that, even if you have a job, make steady income, right? If you don't know what to do with the money that's coming in, it's going to go out and you're not going to get anything out of that, right? So I think it's important to help educate people, which is why I am doing this right now. Hopefully this can become like a monthly thing, or we'll see. But for now, we're here right now, and this is going to be the first kind of live stream that I'm doing. So yeah, it's a little bit about me. So what is this whole live stream about? What exactly are we going to cover? So I'm going to explain and debunk 5 different myths about money, right? 5 different ones that I picked that I think cover a wide variety of topics within finance, and I like those. I like them, right? The myths, I think, are pretty good. These myths, right, they help stop people from managing their finances properly, right? When, you hear these things, right, from maybe other adults in your life, people you work with, people who you go to school with, it doesn't matter. But you'll hear these things from other people, right? And over time, these can become ingrained into us. So much so that you don't even think that it's a myth or it might be kind of false. It's just like, oh, yeah, that's obvious, right? Like saying the sky is blue, right? That's obvious. But it's kind of like that, right? Where you think these things are completely obvious when they're totally false. And the last myth, number 5, is the best example of just that, right? So disproving these myths, it helps us understand money better, right? We're able to understand, oh, this is like that and that's not like that, and how this works and how that works, right? And not only does it help us remove these bad ideas from our heads completely, but it also helps us, like I just said, get a better grasp of how money works, how these kinds of things, play out, right? And once you understand things, right, you can actually apply that to real life, right? If you're an adult, right, you can do it right now. If you're a kid, then you'll have this knowledge early on, so you can sort of build up upon that over time. And when you can do that, right, it's even better, right? Because even though you can't do anything right now, right? I'm just a kid, right? There's nothing I can do right now. I don't have a job. I don't have any income. I might have an allowance. I might not have an allowance. But the point is, when you learn this from a young age, which is my target audience, right? I'm trying to reach people who are my age, who are a little bit older, who are still in school. And even if you're not, it doesn't mean that it's not, this webinar or live stream isn't not for you. It's just that the earlier you learn about these things, the better, right? So before we start, I'm going to go into a would you rather, all right? So I'm going to set up a poll really quickly on the live stream. You can vote on that poll, or and you can type in the chat. Do both, because the more the better, right? So the would you rather, which I'm going to set up right now. So, would you rather get $1 million right now or get $10 million in 15 years? So, I'm going to put a poll in the chat. And it is live. So the poll is up right now. You can type in the chat if you want, which I encourage you to, because this is a kind of complicated question, because there's so much going on right now, right? 1 million now, 10 million in 15 years. What would be better? What would appreciate more? And there's also just the personal aspect. Yeah, I want $1 million right now. I want to have a better lifestyle right now. Or no, I want to wait, right? And hopefully later on, right, that big gap from way less to 10 million is a lot bigger than that gap from less to 1 million, right? So I encourage everyone to type in the chat and explain their answer a little bit. I'll give everyone a couple minutes to do that. You can also vote in the poll. So All right. We have 3 votes in right now. 6 votes in. So a lot of people, some people said $10 million in 15 years. Some said $1 million right now. If you want to explain your answer, which I encourage you to, you don't have to, you can. But if you don't want to, that's fine too. So to the people who are choosing $10 million in 15 years, right, that's a long time. And I encourage, again, everyone to type in the chat, why, right? Like, what exactly, because, you're waiting quite a while to get that money when, if you have the $1 million right now, it can start appreciating, you can start investing it, you can start doing things with it right now. And by the time 15 years comes, right, that may or may not be as much as $10 million or maybe more. So if you want to explain your answer, you can. We're going to move on in a minute. So a couple more people voting for $1 million right now. Someone commented in the chat, what if I'm dead in 15 years? That's pretty fair, and I would not look on life that morbidly, but if you have a really risky job or you're involved in dangerous activities, I don't know what it could be, but if you think you're dead in 15 years, then $1 million right now would be a lot better than $15 million when you're dead. So, I mean, there's that too. We're going to move on in a minute. Yeah. So, now I guess we can start the myths. So, myth number 1. You need to be rich to invest. Now, where does this stereotype come from, right? When you think about investors, right? When you think about, like, anything you see that's related to money online or anywhere really, right? Old people pick the $1 million for sure. Yeah, I think if you're a little older, $1 million right now seems a little safer. Now, you need to be rich to invest, right? That kind of myth, that stereotype comes in when a lot of people, right, when you think about investors, right, you'll think about these really rich people, right? Because they get rich from it, right? You'll think about people like Warren Buffett, right? These multi-billionaires who have gotten their money from investing, right? These day traders, Wolf of Wall Street, right? They're all rich, right? So, that it makes sense, right? Everyone who invests is rich, and therefore, to invest, you need to be rich, right? Because investing doesn't like double your money in a day, right? It might double your money in like 10 years if you're good. So that's a long time. So to start building money fast, if you have a large chunk of money, right, and this is basically compounding interest, if you have a lot of money, right, that can grow a lot faster than a little bit of money, right? The issue with this is you can actually just start investing right now. Literally, if you have like $10, it's not that hard to start investing, just because there are things like fractional shares, right? Fractional shares are basically when you have when you buy part of a share, right? Share prices today can be high, right? $100, $200, $1,000 even, right? So you can just buy small pieces of these stocks. And the way you do it is like apps, right? There are things like Robinhood, Charles Schwab, Fidelity, right? These different brokerages, right? You can download the apps, you can set up your account, and you can buy small pieces of these shares, right? And yeah, sure, like you can, but then isn't it just going to grow really, really slowly? And the truth is, yes, it will grow slowly. But if you continue to put in money, $5, $10, $15, $100 a month maybe, right? Slowly, you're going to get more and more money back. Not just from your money accumulating, but also from some companies pay dividends. meaning if you own a bunch of shares, they'll pay you a little bit of money just like that, which helps them in a few ways, but it's just like a small source of income from these shares without even selling them, right? And then when you eventually do sell them, that's a lot of cash. So continuing, right? Consistency is basically the key when you're investing, right? You need to consistently add a little bit more and more and more over and over to get to where you want to be, right? Having a lot of money invested in the stock market and eventually liquidating it into cash and maybe saving it in a bank account. But now the thing with the stock market though is, right, you see these like headlines, stock market, just a few weeks ago it kind of crashed and these different things happen, right? The stock market is risky, right? That's the second myth that I'm talking about today. And where does this come from? Well, it comes from a lot of things. One of them is the media exaggerating some things, right? The stock market crashed and it fell a few percent. And these things can be scary, right? People lose hundreds of thousands of dollars in a day, right? The latest economic recession in 2007 to 2009, right? Even though that was the housing crisis specifically, all stocks plummeted, right? The economy was doing pretty badly. The Great Depression, 1929, that was awful too. That lasted for 10 years, right? So these things where I put my money in there, and yeah, it goes up, but it's eventually going to come crashing down, right? And that's the problem with the stock market. Now, yeah, sometimes, right, and you also hear things about companies, right? Their share prices fall drastically, right? Like Tesla, it dropped, 40% since the beginning of the year? I don't know the numbers right now off the top of my head, but it was a lot, right? So, I put my money into Tesla thinking it's going to go up, and then it comes crashing down. And yeah, these things do happen, right? It's not uncommon. In fact, Tesla is a pretty interesting example. It's one of the biggest companies in the world. You'd think it would be safe, but it's not. But Tesla's a little different, and I'll get to that in a second. But how exactly can you make money from the stock market without it being risky? Because yeah, I mean, it's a myth right now, right? I'm telling you guys that it's not risky. The first thing you need to understand is with anything you do, there's going to be some amount of risk, right? You're buying a house, right? The housing market in that area specifically could go down, right? And the house is worth less. Government bonds, if the government fails, then the money that you get, it's not going to come back. And even if you do get it, right, inflation might beat out bonds, and bonds are something a little different. You invest into like art, or NFTs were big a few years ago. Now they're pretty worthless. So with anything you do, when you put your money into something, there's going to be risks. But there are ways to lessen these risks significantly without it hurting your potential gains too much. Now, the thing is, you can't ever have something that's zero risk and 100% reward, right? That's not how these things work. Otherwise, everyone would be rich, and that's not possible, right? But there are ways to invest properly and invest smartly. Now, the first thing that I want everyone here to understand is what is the difference between single stocks, what are mutual funds, and what are index funds. All right, now single stocks can be risky, right? Like I just said. Single stocks are basically the stocks of a single company. Think of anything. Pepsi, Apple, McDonald's, right? Anything. Pizza Hut, right? All these companies, they have, or not Pizza Hut. It was a different pizza company. But all these different companies, they have stocks, right? They're listed on public exchanges. The U.S. companies are all either listed on the NYSE, the New York Stock Exchange, or the NASDAQ, which a lot of tech companies start, where a lot of tech companies go public. The NASDAQ used to be kind of inferior until Microsoft listed on the NASDAQ, and it blew up, and now the NASDAQ is basically like the stock exchange that all the tech companies go to. But that's not important right now. Whatever. So these single stocks, they can be listed on different exchanges, and you can just buy shares of them. Like I said, fractional shares exist, or you can buy many shares. You can buy thousands of shares, right? Now, the thing with single stocks is that they're tied to one company, right? Someone said yeah, Mod Pizza, Domino's, Domino's. Yeah, that Domino's was the one I was thinking of. So now the thing with single stocks is they're tied to one specific company, right? Meaning if that company specifically does pretty bad in a quarter or wasn't able to deliver something that they promised to, or they had to fire a bunch of people, different things that happen, the the stock goes down, right? Because those stocks are tied to a single company. Now, there's now you've seen the stock market, right? If you click 10 years on the graph, it goes up, right? Meaning that the stock market, no matter, right, in the long run, it will always go up. That's why so many people invest on it, right? But I don't want to put all my money into one company because what if it crashes and then literally never comes back to where it was when I bought it? That's happened to a lot of companies. Companies have gone bankrupt, right? One example of this is AMC, right? Their stock surged and now it fell and it's pretty low and it hasn't gotten to that point since. Now, the way to counter this is to invest your money in hundreds of companies. Now, the thing is, how do you know which hundreds of companies to invest in, right? There's so many different options, right? There are literally thousands, and this is just in the US, there are a ton of companies. That's what mutual funds, that's where mutual funds come into play. Because with mutual funds, you're basically investing into a collection of stocks that are handpicked by a bunch of professional investors. And what happens is these stocks will eventually go up because they've been picked out by professionals. Will they go down? Yeah, they will go down. But in the long run, they're definitely going to go up. They're going to go really, really high. And even if one company fails, right, that's just that one small thing. All the other ones will continue to do better. And so it's like diversifying your market, diversifying your money, right, within the stock market, right? You don't carry all your eggs in one basket. You split them up. So it's safer. Now, the thing with mutual funds, though, is that, right, you have these professional investors helping choose out which stocks you're going to pick, right? Now, the thing with that is they're not doing that for free, right? So they're going to take a percentage of your profits, whether it's going to be like an upfront pay or it's just like a percentage of the money that you make, right? They're going to take some of that, right? And so that's kind of that trade-off, right? Like if the mutual fund didn't do that great and they still took some of your profits, then you're basically left with nothing, or maybe even worse off. So that can be something that makes mutual funds a little less appealing, which is why index funds are way more popular. Now, with index funds, there is no person picking out which stocks are the best ones, which are the worst ones, what do I do, right? It's a collection of stocks. Now, these collection of stocks, for example, the S&P 500, right? This SPY. So you've heard of the S&P 500 before. It's basically a collection of the top 500 U.S. companies, right, listed by how big they are, right? So Apple's at the top. As of recording this, Apple's at the top. Then it's Microsoft, then Nvidia, then Amazon, then Google, and so on. These are all U.S. companies, by the way. That's what the S&P 500 tracks, right? The top 500 biggest companies. Now, the SPY, that's what the S&P 500 is, right? It's a collection of all these. The SPY tracks that, meaning you put money into it, and automatically your all your money is diversified across these 500 different companies. Now, these 500 different companies, they might not be all great, right? There might be a lot of them who kind of suck, right? And there might be a lot that are good. There might be a lot that are bad. But the thing with index funds is there's no one person picking out which ones to choose, right? It's just automatically at the beginning of each year, right? It's reordered like the biggest companies. So no one's actually doing any work here, meaning no one's eating into your profits. It's just you who has your profits, right? Now, this ties into diversifying your portfolio. Now, the money you put in is split across hundreds of different companies. And so without you having to manually pick which ones to do or just randomly selecting them, because the biggest 500 companies in the world, they're the biggest for a reason, right? They have good, the products that they create are good. Investors are happy with it, and that's why their stock is so high. So that that's why you need to diversify your portfolio. The stock market is definitely risky if you put all your money into one penny stock and then in the next couple weeks it crashes 95% and you're left with nothing. But if you take the slow route, diversify, and wait a long time, continually adding a little bit each month, each week, whenever you get your paycheck, like 5% of it or whatever, it's going to add up and it's going to be worth it. But single stocks aren't all that dangerous, right? Single stocks can be pretty safe if you know what you're doing. See, when you ask someone what they're invested in, right? The good investors, almost all of them never invest in single stocks unless they're really sure and they've researched the financials and everything. But normal people who don't have day trading or investing as their full-time job, right? It's easiest to just put your money into an index fund. But it's also good to diversify your money across different index funds. And I know that sounds complicated, but it's really not. A lot of people will have it split across things like the Dow Jones Industrial Average, the S&P 500, the QQQ, which tracks the NASDAQ 100, which is the top 100 biggest tech companies in the US. So diversification is key, because when you're diversified that much, you're basically putting your money across the entire stock market. And different things will be weighted a little differently. Maybe, you think that the tech sector is going to do good, so you have more money in the NASDAQ 100. Maybe you think, different things would do better. And so that's kind of what happens, right? It's kind of up to you how you want to diversify your portfolio. But the main thing to remember is diversification is really important. Now, when are single stocks safe, right? I talked about them. I kind of said they're bad, don't buy them. But they can be pretty safe. For example, a lot of the big companies, right? They're called blue chip stocks. All right, these really big companies, right? Like Apple, Nvidia, Microsoft, Google, Amazon, Berkshire Hathaway, Tesla, Meta, all these big companies, right? They're really big companies, so they're called blue chip stocks. These are typically safer than things like penny stocks. Now, penny stocks are companies whose stock price is literally pennies, right? It's less than $5 or less than $1. I can't remember the exact number. But these companies, right, their stock prices are really volatile, and they can change rapidly. You can gain a lot of money in one day and then lose it all the next. So that's something important to keep in mind, that that single stocks can be risky. But if you're investing in really big companies that are less volatile, like for example Berkshire Hathaway's stock, if you look at the numbers, it's less volatile than the market on average. So that's it's a much safer company to invest in. Can it still do badly? Yeah, definitely. But single stocks aren't dangerous if you're confident that the company is going to do well, you've researched them a little bit, and they're not that volatile. So yeah, stock market is not risky if you know what you're doing. Next, myth number 3, saving is adequate for financial success. Now, that kind of makes sense, right? Saving is what you need to do. And the wording is a little tricky. What I'm trying to say here is saving is the only thing you need to do to be successful financially. And as much as I'd like that to be true, because saving is like 1,000 times safer than investing, saving is only part of the equation, right? So there's a difference between saving, which is passive, and actively investing, which is active, right? Now, with saving, you're putting your money into a bank account, right? It could be a normal checkings account, which could, offer you like 0.1% interest per year, or it could be something like a high yield savings account, which gives you more interest. And really quickly, if you're confused why different accounts offer different amounts of interest, it's basically how lenient they are with you taking out your money. Like in HYSA, which is a high yield savings account, it's going to give you more interest. But the thing is, you're not just allowed to just take all of it as soon as you want, right? There's kind of like a lock on it. And to unlock the lock, there's a process. You have to wait a little bit. And the reason they do that is because then they can do whatever they want with your money. Bank themselves can invest it, and they can keep it there. They don't need to give you your money. And in return for that, they're giving you more interest. So it's a trade-off. But anyways, saving is just a part of the equation, right? It's not the entire thing, right? So the only thing that yeah, so with saving, you're not able to get as much money as fast, right? Because when you're saving, that's like a couple percent every single year, right? Maybe 0.1%, maybe 3%. Not as much as investing, where you could get 10% pretty easily, pretty safely too, if again, you know what you're doing. So that's why saving is passive, right? It doesn't generate as much. Investing is active. Now, the thing that you might be wondering about is, well, didn't you say that there's a trade off between saving and investing? Yeah, there definitely is. When you invest, you're taking on a risk that you could lose a lot of money. When you're saving, the only thing that you need to be worried about is the bank collapsing. And I mean, if the bank was collapsing, you'd have a lot of other problems too, like your job and the entire economy as a whole, right? Bank Keeping your money in banks, yeah, I mean, things have happened before, like different financial crises, again, 1929, 2008. But those were only two times in the last 150 years. So it's a lot safer to put your money into banks. Investing, stock market goes down pretty often, went down like a few weeks ago. Different things that you can buy, because investing doesn't literally just mean buying stocks, right? It could be buying government bonds, it could be buying houses, it can even be like buying things like oil, gold, art. A lot of these different things are considered investing. Now, are some things going to be a little riskier than others? Yeah. If I buy an art piece for $1 million and then I try and sell it, no one wants it, and then it's valued at like 100K, then I just lost 90% of that, right? Whereas, that typically doesn't happen nearly as much in like the stock market. So there are riskier and safer ways of investing and saving. But it's important to realize that there's a lot of you can't just do one, right? If you put all your money into investing, then you could lose all of it. You don't have any backup. If you save all of it, you're not going to grow anything. There has to be kind of a balance, right? And someone asked, do you have any recommendations on to save versus invest? So when it comes to, how should I diversify my portfolio over making it too risky, making it too safe, right? Really, that's up to the person you're asking, right? I mean, if you have a lot of responsibilities and losing a lot of money is really, really dangerous for you and could really, really hurt you, like a lot, then saving a little more would be better than investing. But if you're a lot younger, and you have money, even if it's not a lot, maybe if it's a little bit, right? Investing it could be better, right? Because you could get those higher returns. And even if you lose some of it, it wouldn't be detrimental to you or whatever, right? As far as like a golden number, there honestly really isn't one. I mean, if there was one, then everyone would be using it. But then again, a lot of people don't even do both saving and investing, right? It's important to do both. So there's no golden number for anything really in finance. And I mean, there are charts and mathematical equations that show you like how much risk versus how much reward, and like the different graphs. And there's a lot of complicated, nerdy stuff. But the gist of it is, if you're kind of like not too crazy about making a lot of money, then it's actually better to, I mean, personally, if you're younger, I would do something like a 60-40 split, or maybe a 70-30 split with investing to saving, right? And that's a lot riskier than you would think it is. But, if you're a lot older, you're in retirement, you're nearing retirement, having something like a 60-40 split versus saving and investing would be better, right? So there's no golden number. There's no perfect answer to that question, it's a really good question, by the way. But, I mean, it really depends on what your needs are in that time of your life, right? There were some comments the chat that I didn't read. Back to the poll. Someone said they picked they they picked the $1 million so that they can save time and put money in the stock market and make it grow. Yeah, I mean that's the best argument to why you would even pick the $1 million in the first place, right? It can appreciate a lot quicker, which is important. Index funds, yep, spreading your money across multiple platforms. And yeah, if you type in the chat, I'll read it. I was not checking chat earlier, so I'll do that now. You type something in, I won't forget about it. But yeah, saving is not adequate for financial success. It's half of the equation. If you want it to be half, you can do 50-50, no golden number. Now, myth number 4. Credit unions are safer than banks. Now, this one's a little weird. What are credit unions? What do you mean by safer? There's a lot of things. I'm going to explain them all. You're not going to be left with any questions, and if you are, again, there's the chat. But what are credit unions, right? Now, credit unions are basically pretty similar to banks, right? So what are banks, right? Banks basically offer people, their customers, a safe place to store their money, right? You're not going to get robbed if you keep it all, because if you keep it all in cash in your house, right, it's not safe. So banks keep it safe. Another thing banks do is they make sure they'll give you small percentages of interest, meaning every year you'll get 1% maybe, or 0.5% of your money that you invested. And different banks have different accounts, right? Again, high yield savings account, that's a lot more interest, meaning that money that you save in there, right, is slowly growing without you even doing anything. Now, why do banks even offer this, right? What are they getting out of that? Aren't they losing money? Now, the thing is, when you put your money into banks, right, your money actually isn't there. They just take it. They just have a note saying that, oh, Nirvan has $500 in Bank of America, right? They don't actually have it there. What they're doing with that money is they're investing it into different things. They're using it, right, for a lot of different things, right? Everything that I covered about investing and more, right? They're investing. These banks are investing, right? So that's the thing with banks, right? They're investing everything, which gives them higher profits than if they just saved. So those higher profits, they'll just take a small chunk of that and just give it to you, right? As kind of like a way of saying, this is why you should keep your money with us, right? That's the point of keeping your money in banks, right? Getting that little bit of interest every year, right? Now, that's what banks do, right? So can't banks lose a lot of money investing? Yeah, they can. And when that happens, we have depressions, right? Which suck, but that's what happens, right? If the stock market does bad, then banks fail, then everyone can't get their money out. But in 1929, after the Great Depression, the U.S. government realized if banks fail, everything fails. So FDR, in one of his New Deal programs, he actually created something for banks called the FDIC, which I'll get to later, which kind of insures your account up to a certain amount of money. But what are credit unions, right? Now, credit unions, so banks, they're for-profit institutions, right? They're businesses, right? They're trying to make profits for their shareholders, right? For the people that have invested in them, right? I invest in JP Morgan and Chase, right? JP Morgan and Chase is trying to make a profit, so for the shareholders, basically. That's what a lot of these companies do. And they're very, very similar to credit unions. But the thing is, with credit unions, they're nonprofit. All right? These are member-owned, meaning the customers, right? Like everyone who puts their money in, right? We all have a say in, how it operates, how it works. Because no one person owns it, or no board of directors owns it. Shareholders don't own it, right? Board of directors don't own companies, by the way. Misspoke. But with public companies like Apple, right, you buy a share of Apple, meaning you own that tiny part of Apple. Is it big enough to make a difference or give you any vote in anything? No. But you still own a part of that. With credit unions, they're nonprofit, right? Now, the thing with credit unions they typically offer lower loan rates and higher savings rates than banks. Because with banks, when they invest, they're trying to get their profit to their shareholders, right? And they'll give you a little sliver of it. But with credit unions, there's no part when they invest it, they're going to invest a lot less because they don't have any shareholders to give it to. Meaning, even though they invest like a little bit, that little bit, they can just give it all to you because with the other money, they're not doing anything with it, right? So, in some ways, yeah, they can be a little bit better, right? They can give you more, but they're not necessarily safer, right? Credit unions are usually a lot smaller than banks, right? Sometimes they're bigger than some banks. Typically, credit unions are a lot smaller. And the reason behind this is because banks are seen as this giant corporation that has a bunch of people working for them who are professionals and they know what they're doing, whereas credit unions are kind of like this thing where a few people who put their money in will help out, right? It's almost sketchier in a way, and it's not, right? Credit unions, they're both safe, right? The point of this is they're both equally safe, but they operate in a little different. They operate differently, right? So with banks, right? I talked about the FDIC, which is the Federal Deposit Insurance Corporation, meaning if you put your money into a bank and it collapses, the U.S. government will walk up to you and give you up to $250,000 that you invested. Meaning, if you invested $100,000 that you saved, right? Meaning, if you saved $100,000 in the bank, then it completely fails. It goes bankrupt, right? The U.S. government will give you all that $100,000 back. Now, if you invested $1 million and it collapses, you'll get $250,000 back. That's the max. So the rest of the $750,000, it's lost, right? Because they can't insure everyone everything they own. Because what about like billionaires? It'll be way too much money for way too many people. Now, credit unions also have are also insured by the National Credit Union Administration, NCUA. So with the NCUA, it's the exact same, $250,000 per customer, depositor, right? So again, same thing. You invest $1 million, you're gonna lose $750K. But if you invest like $50K, you're gonna get all that back. So credit unions are, in the end, very similar to banks, right? They operate a little bit differently and have different safety. As far as safety goes, they're the same, right? They're both very unlikely to fail either. So it's important to not. So yeah, I mean, they're both pretty safe. A lot safer than investing. But remember, saving is not adequate for financial success. You also need to invest. As far as credit unions and banks, they're the same. Now, there is one more myth that I'm going to talk about for a bit. It is definitely the most important one by far. And a lot of you have already heard this. Even if there's one person who's watching who hasn't heard about this, it'll still be really important. Myth number 5, debt is bad. Now, when a lot of people think of debt, right, let's think of what's the first thing that comes to mind, right? Maybe if you're a student debt, student loans, right, can be a lot of money, up to hundreds of thousands of dollars. And if there's anyone who's a student right now, you can probably relate. You might not. But debt is seen as something where I owe money to someone. This isn't good for me, right? With debt, there's a lot of different kinds of debt, right? It could be you owe your friend $5 for a candy bar, and now he gives you the candy bar, but you didn't pay him back. You said, oh, I'll pay you later, and now you're indebted to him, right? You need to pay that $5 back. With adult money, that number becomes 500,000, right? For example, let's think. So that actually ties into why debt is kind of a good thing. But debt, it kind of stems from, I owe money to this person, this group of people. And honestly, debt is not bad, right? It is a tool. And that might sound confusing. I thought debt is a thing that you owe to someone. It is. How can I leverage debt is a different question, though, which is what I'm explaining now, because tools are used to leverage things. You use a wrench to tighten a bolt because you can't do it with your hands. That's too hard. The wrench uses leverage. All tools help you leverage things. With debt, you can leverage a few things. The first thing you can do is you can buy things that you can't buy. Now, I know that sounds really weird. How can I buy something that I can't buy? You can basically purchase things that you don't have the money for. There are a few forms of this. The first one that comes to my mind is a mortgage, right? You want to buy a house. Let's say it's a $100,000 house, but you don't have $100,000 laying around, right? If you listen to anything that I've said before, you probably had it invested or saved rather than just sitting around at home. But with debt, you can basically walk up to the bank, say, I have 20% of this $100,000, which in this case, $20,000. I have this money. I'm going to pay this 20%. Typically with mortgages, you need to pay at least 20%. This is called the down payment. And with that 20% that you've paid, the bank's going to say, all right, I'm going to pitch in the 80% right now. But there's a few things. Number one, even though you're allowed to live there, you can do what you want, it's technically still the bank's property. Technically, the bank is allowed to repossess your home. Now, why would they repossess it? Because when you pay down that 20%, that down payment, that other 80%, you're going to split up into smaller chunks and pay that over time, right? Like 1,000, 1,000, 1,000. That'd be really slow. Maybe 5,000, 5,000 every single year, every single month, right? Whatever. And slowly you'll be able to pay that off. Now, if you stop paying it off and you refuse to or you're not able to, the bank is going to repossess your home. And they're going to take it, basically. And they'll own it. Now, if you keep paying it off, eventually you're going to pay off that full $100,000. And now the bank is just going to say, okay, now this property is officially yours, right? Now, why does the bank even do this, right? Banks try and earn money, but right now they just help you out. The thing is, when you're paying off that $100,000 a little bit over and over and over and over and over, there's interest. But not the good interest that you get from banks with keeping your money. It's the bad interest where you need to pay more money, right? If you take too long to pay it out, right? Like let's say you take way longer than you need to and you only pay like $1,000 a year, right? No bank is going to let you do that. They're going to repossess the home. But even if they did allow you to, the issue with that is you're going to be paying a lot of interest because each year there's going to be a little bit more you have to pay, that added amount of interest. So the best thing to do is pay it off as quickly as you can, which is the case for every single piece of debt you get. There's no good reason to wait and take a long time. Of course, if your situation's different, right, your paycheck is different, the things you're investing in and saving things are different, everyone's scenario is going to be a little bit different. But rule of thumb, pay off your debt as fast as you can, basically. Now, that's with the house, right? Now, you're not buying a house every other day, right? If you are, you probably know all of this right now. But something you do probably use every day is a credit card. With credit cards, it's basically pretty similar with as far as debt works, but it's not the exact same. With credit cards, what you're doing is, you go to like a store, right? Let's say it's the grocery store, right? And you buy groceries. Let's say you spend a lot of money and it came out to $100 because that's a fun number. Now, you swipe your credit card, you're not actually paying any of that money, right? Meaning that you can technically just keep swiping a bunch all around and your money isn't directly going anywhere. It's just slowly building up. in your account, and at the end of the month, you need to pay all that out, all of that, right? It's a little different than debit cards, where when you swipe your debit card, right, the money directly goes from your bank to like the store, right? With credit cards, the money goes from the credit card company to the store. But the credit card company makes a little note saying, now you've paid this much money, right? And they keep tallying it up. At the end of the month, they add it all together, and that much money, let's say it was $3,000 for that month. That much money is how much you owe, right? And the best thing to do, like I just said, what do you do when you have debt? You pay it off as fast as you can, right? And if you know how to use debt properly, you'll pay it off instantly because you don't want it to accumulate. Now, the thing is, if you don't pay it off, a few things happen. Number one, interest. You're going to have to pay more and more and more later on, right? Which is not good, right? Eventually, it's going to become really expensive. And number two, your credit score drops, right? Now, your credit score is something that is used to measure how good is this person at paying their debt, paying the things they've owed, right? Or how good are they with their money, basically. And this is used when trying to like take out a loan for a house, right? A mortgage. When you take out a loan for a house, they're going to look, what's your credit score? If it's really low, then they're not going to like let you they're not going to pay off that $80,000 for the house because they don't think that you're going to be able to pay it back. And repossessing the house and selling it, it's a hassle. They don't want that. The easiest thing that they can do right now is to say no. If you have a really good credit score, they'll trust you. Now, your credit score fluctuates, and we have another would you rather in a sec about that. But your credit score will go down if you're not able to make payments on time, especially your credit card, right? So when you take advantage of debt, it can be a problem. Your credit score goes down, your loans and bills start racking up for things that you didn't pay, and you say, oh, I'll pay it later. Then the new ones start coming in, and you have to pay more and more money every time you wait because of that interest building up and up and up, right? So it's going to be harder and harder and harder to pay it off the more you wait, which is why it's really important to pay off debt as soon as you can, because when you get into like things like credit card debt, it can be problems, right? You take out new credit cards and then to try and pay off those, and take new ones to pay off those, and eventually you're denied to take out any new credit cards because your credit score goes down when you take too long to make those payments. So debt is really, really dangerous if you don't know how to use it, right? If you don't know what you're doing. And it's scary, right? People get into things like student debt, and it can take them like half of their life to pay it off, and it sucks. But if you know what you're doing, you know how to manage debt properly. And the way to manage debt properly is, number one, pay it off as soon as you can. I can't overstate that. No one can. No one can overstate how much you should pay off debt as soon as possible. Pay it off really quickly. Don't bite off more than you can chew, right? Don't spend $15,000 a week on your credit card. First of all, your credit card isn't even going to probably allow that, right? You're going to have a credit limit. And if you don't know what you're doing, you're not going to be able to pay it off. But what exactly is debt really good for? Yeah, it can get you things, but how would it work for a credit card, right? You're going to have to pay it off anyways, and that's such a short time frame, 1 month. But that short time frame can help, right? As much as debt can make your credit score go down, it can make it go up. Because if you pay everything on time, you're really good with your payments, right? As far as credit cards go, your credit score is going to go up and up and up and up and up, right? Because you're doing a perfect job of what you're doing. When you take out big loans, it'll automatically go down, and that sucks. And, right, you take out a mortgage on a house, you take out a mortgage on a house, your credit score is going to quickly drop right now because that's just how it works, right? Because if you're taking a loan, that means that, okay, this person has a loan. So if you try and take out another loan, the reason for the drop is so that the other place that you're taking a loan from knows that, okay, this person has taken a loan for a house, meaning they'll have more loans to deal with, right? So taking a loan on a house will decrease your credit score in the short run, but if you make the payments, right, credit card payments, mortgage payments, whatever loans, student loans, then over time it's going to go up and up and up, which is really useful. The second thing, with debt being a tool, right, you can buy things you don't have. We already discussed the house, but for example, your credit card, you might not actually have any money in your bank account because you're getting your paycheck like tomorrow, but you need to buy something, so you can just swipe it on your credit card. You get your paycheck, then the next day you need to pay it off, right? 'Cause let's say it's at the end of the month, and you just pay it off, and there's no negative, right? Nothing bad happened. You got something a little earlier. It's a win-win, right? So making sure that you can manage debt properly is really, really important, and it's the most important thing that I've talked about today. So quick recap, and we'll transition to the end of the live stream. Number one, you don't need to be rich to invest. A little bit goes a long way, and consistency is the key. I didn't add that here. Consistency is the most important thing when starting with small numbers, even with bigger numbers, right? Being consistent with what you're doing, really, really important. Can't overstate that. Number two, the stock market is not risky. There are lower and higher risk choices that you can make, right? Things like investing all your money to small penny stocks. That's really risky. Things like investing all your money into a bunch of diversified index funds, basically covering thousands of stocks. That's way less risky. Now, can you make like millions off of penny stocks in a day? Yeah. Can you also lose all of it? Yeah. So there's that to keep in mind, right? With everything here, with the middle three specifically, right? There's that fine balance between risk and reward, and that is the most important. I'm not gonna say the most important thing when it comes to talking about like finances in general, but it's among the top 5, right? Being able to properly manage risk versus reward. Now, myth number 3: saving is not enough for financial success. Now, again, right, you need to be able to save. Active, right? You need to actively be earning money. And I'm not talking about your job. I'm talking about things outside of your job, right? Saving versus investing. Investing too much of your money, you can lose it all. Saving too much of your money, you're not going to have anything by the end of retirement, right? Number 4, credit unions are safer than banks. I need to change that. Credit unions are not safer than banks. They're the same. It really does not matter what you put your money in. It comes down to preference, honestly. They're just different. Learning about them is pretty interesting too. I would recommend, if you're a little interested in how credit unions operate, how banks operate, because banks are pretty cool, and it's all pretty cool. That's why I'm covering this today. But I think banks are special in their own right, and there are different banks, central banks, and all these kinds of things. But credit unions are not safer than banks. Banks are not safer than credit unions. They're very similar. Credit unions have, again, I forgot the name. It was the FDUC, I think. No, NCUA. NCUA it backs credit unions, and FDIC backs banks. Both guarantee $250,000. Both credit unions and banks are great ways for saving. Remember, for investing, right, there are things like stock market, bonds, a bunch of other stuff. Finally, debt is a tool. A tool is something that you can use to leverage, right? You can leverage your credit score. You can leverage being able to buy things faster. You can use it to your benefit, and it can really, really help you, but it can also really, really harm you. And honestly, debt can really ruin people's lives, right? I'm not overstating this. You probably have experienced this firsthand or known someone who has, right? It's not something that is rarely talked about, right? People pay off it takes a long time for people to pay off things like student loans. Someone said that their son's art teacher just paid off her student debt, and they're teaching right now, and it's probably been a while since they've taught, since they've left school, right? So debt is pretty scary, but if you know what you're doing and you're smart about it, it can really help you in the long run, right? And another thing about all of this, the long run is really important. Investing, saving, using debt, right? This will all help you in the long term. Short-term gains aren't going to get you anywhere, and they might get you somewhere, and then they're not going to get you anywhere after that, and they might push you behind. If you're patient, then you can make a lot of money doing a lot of the things I talked about: investing, saving, using debt, right? But yeah, right before we end the live stream, I'm going to do another Would You Rather. I think I mentioned that I would do something about credit scores, which I am going to. Now, I'm going to set up the poll really quickly. All right, I'm going to create the poll. I'm going to end the first poll. So we got 60-40 split between 10 people. Now, I'm going to start a new poll. Now, big reveal. Would you rather? And this is a little bit different and a little bit more complicated. Again, I would really encourage everyone to type your answer in the chat. But would you rather have a perfect 850 credit score but only $1,000 in savings, or would you have $20,000 in savings but a terrible 400 credit score? All right. So I'm going to create the poll really quickly. All right. Okay. So, would you rather have a credit score of 850 but $1,000 in savings, $20,000 in savings but only a credit score of 400? So, I'll give everyone a minute to type it in the chat, their answer, and vote in the poll. And for this one, I really want as many people as possible to type their answer in the chat, why exactly you picked what you picked, because both are pretty interesting. We have a few votes in right now. Right now it's 5-0, which is interesting. Let's see what more people are thinking about. And for those 5 people who chose 850 credit score but $1,000 in savings, why'd you choose that? Right? I wanna know your reasoning behind it. Because with both of these, it's pretty easy to just pick one, but explaining is a lot more important because these are a little bit more in depth. So I'm gonna give everyone a minute. Answer, type in the chat. And thank you all so much for coming to this. I know our time here is pretty much ending right now. Someone said, can potentially get 20K loan with an 850 credit score. Definitely, right? You can definitely get that money back. And it's difficult to build a perfect credit score. Yes, it is very difficult to build a perfect credit score. The banks can trust you with 850 credit score. 1K is still enough money to invest in. Yes, that's the first myth that I covered. You don't need a ton of money to invest. If you have an 850 credit score, but $1,000 in savings, you're just getting by. When you have a low credit score, all the savings are meaningless because they will have to go straight to the bank. I guess so. Yeah, I mean, having a good credit. Maybe I should have buffed the second option a little bit. How about I change it? Maybe. Would this change anyone's mind if I created a new poll? I think this would be a lot more interesting, actually. Uh, and if you have to go now, that's fine. I did say that this would end at 6, but for now, I think we can wrap this up. If you want to answer the second one, that's fine. But yeah, I think our time here is done. Um, so again, this matters for a lot of things, and I've already covered this. You can leave if you want right now. Having proper knowledge is crucial. Starting young, again, can help you learn these things later on in life, and building these key investing habits can help you earn a lot more, whether you're young or old, doesn't matter, because knowledge can get you anywhere. And so, thank you. I hope to have these web live streams slash webinars, whatever you want to call them, maybe monthly, maybe not, depending on how everyone thought they were. I'm hosting this on my YouTube channel right now. I plan to upload a recording of this in like 25 minutes or something, and I plan to also post videos here more regularly, maybe short form, maybe some long form. And if you found this fun, you can talk about it to someone if you liked it. I'll plan to have another one soon, and if that also has some people join and has interest, I might continue to do these things regularly. If not, I might stop and I might do something else. But I mean, yeah, thank you all for coming. This was pretty fun. I had a lot of fun here today, and I hope you all did too. So, I mean, yeah, I think I'm going to end the stream right now. So thank you all for coming, and I hope you all learned something.